Good morning, everyone. My name is Louisa and I'm an Employment Taxes Specialist at UNW. It gives me great pleasure to welcome you to the very first session of Employment Taxes on Demand. This is the core session where we will cover foundational concepts needed for future sessions. I will be taking you through penalties, the basics of employment income, where we will cover key concepts such as the receipts basis, the cash equivalent of benefits, marginal cost, and then finally the reporting of benefits in kind via P11D forms or pay-as-you-earn settlement agreements. These topics are crucial for both employers and employees to understand as they directly impact how income and benefits are taxed. Any mistakes in this area by an employer or employee could lead to serious consequences. So, let's dive in. Before we get into the technical content, it's really important to understand why this session matters and why it's worth paying close attention. When it comes to tax compliance, HMRC has two types of penalties: unprompted and prompted. Unprompted means that you voluntarily tell HMRC about an issue before they ask. This usually leads to much lower penalties. But if HMRC discovers the issue themselves, that's a prompted disclosure. And the penalties are typically much higher, up to 100% of the unpaid tax. And this isn't just theoretical. Employers are facing serious financial and reputational consequences. We've seen companies hit with six-figure penalty bills, especially where benefits like company cars, loans, or other taxable perks weren't reported properly. What's more, HMRC can, and does, publicly name and shame companies for non-compliance. That can really affect how your organisation is seen by clients, investors, and employees. So while today's content might seem a little technical in places, I encourage you to stay engaged. Getting this right protects your organisation's bottom line and its reputation. Now that we've covered penalties, let's move on to the technical content, starting with how employment income is defined. At its core, employment income refers to the total compensation an employee receives for their work. This includes not only wages or salary, but also benefits and perks provided by the employer. During the session, I'll be using the term benefits to refer to benefits in kind, and I'll explain anything extra as we go along. Now, let's break this down further. When we talk about employment income, it covers cash payments, so this includes things like salary, wages, bonuses, and commission. Any benefits in kind, for example, company car or health insurance. And finally, any other taxable benefits, for example, staff entertaining. In today's session, our primary focus will be on how to account for and report various sources of income, with particular attention to non-cash benefits. The approach will depend on the nature of what is provided, whether it's a cash or benefit, and will involve A, how the income is reported, and B, whether tax tracking is required, along with the applicable type of national insurance. Another thing to note before we move on to how employment income is accounted for, it's important to understand the structure of the UK tax year. Unlike the calendar year, the UK tax year runs from the 6th of April to the 5th of April the following year. This means that when we talk about income, tax allowances or deductions, we're referring to financial activity that occurs in this specific 12-month period. For example, the 25-26 tax year started on the 6th of April 2025 and it will end on the 5th of April 2026. Understanding this time frame is crucial because all income, including employment income, is assessed within this window for tax purposes. It affects when you report income, when tax is calculated, and when allowances reset. During this session, I will be using rates from the 25-26 tax year, and these will be subject to change, and so it's really important to remember to check the current rates when doing any calculations. Moving on. Let's begin by looking at the first important concept, the receipts basis of taxation. This is the system used for accounting income from employment. Under the receipts basis, income is taxed when it is actually received by the employee, rather than when it is earned. Here we have a simple example. If an individual carried out work during March 2025, They were then paid for that work at the end of April. Therefore, since they have received the income in the 2025-26 tax year, they will be taxed using the 2025-26 rates, even though they actually earned the income in 2024-25 tax year. Therefore, the employer must understand when a payment is made and therefore arises for pay-as-you-earn purposes, so it's taxed correctly. While this concept is easy to understand for employers, for directors, it's a little different. For directors, money earnings are treated as received for assessment purposes on the earliest of the date when the earnings are credited in the company's accounts or records, where the amount of earnings is determined before the end of the period to which they relate, it is the date that period ends. And finally, where the amount of the earnings is determined after the end of the period in which they relate, is the date the amount is determined. So these rules are applicable to cash payments. However, for non-cash benefits, the timing of when they are received can be a little tricky, but let's cover this in our next slide. When we tax a benefit, it is always taxed in the year it was received. This applies to non-cash benefits, and these are benefits such as company cars, free accommodation, or private health insurance, which are typically treated as taxable income. However, because they are not paid in cash, the tax authorities need to determine their value for tax purposes. This takes us to the concept of the cash equivalent of benefits. The value of a non-cash benefit is calculated using a cash equivalent, which is the amount of money, including VAT, an employee would have to receive in order to get the same benefit. There are two ways to find a cash equivalent of a benefit. The first is using the cost to the employer for providing that benefit, and the second is using special rules created by legislation. This value, the cash equivalent of the benefit, is then added to the employee's taxable income and taxed accordingly. Where a benefit is provided to employees will also pay Class 1A national insurance contributions on that cash equivalent. Now let's take a look at the two different ways that we value benefits for tax purposes, using the cost to the employer and the special rules. I'll walk through some examples to make this a bit clearer. We'll start with the simpler method, where benefits are valued based on what they actually cost the employer to provide. A common example is private medical insurance. If an employer pays an annual premium of £100, including VAT, for an employee's private medical cover, then the full £100 is the cash equivalent of the benefit. That's because it represents the amount the employee would need in cash to buy the same benefit for themselves. The employer, who provided this benefit, will have to pay Class 1A national insurance on each cash equivalent of the benefit. So this would be £100 times 15%, which is £15. Now let's move on to one of our special rules, which was applied to specific types of benefits where the simple cost to the employer approach wouldn't give us a fair taxable value. The first example is a company car. The value here is based on the list price, its CO2 emissions, and how long it's available to the employee during the tax year. For example, if the list price is £30,000, the CO2 percentage is 16%, and the car is only available for half of the tax year, then we calculate the benefit as £30,000 multiplied by 16%, and then multiply by 6 over 12 for how many months it was available. That gives us a cash equivalent of £2,400. This amount is included in the employee's taxable income and taxed at their marginal rate of income tax, so either 20%, 40%, or 45%. The employer's national insurance for this benefit would be £2,400 times 15% to get £360. At this point, if this seems a little bit complex, then don't worry. We'll be covering company vehicles in more detail in a future session. So moving on, next we have an interest-free loan. A benefit in kind only arises here if the loan exceeds £10,000 at any point during the tax year, and the employee either pays no interest or pays interest below HMRC's official rate. Let's say an employee receives a £20,000 interest-free loan from their employer and it's outstanding for the whole tax year. The official rate of interest is currently 2.25%, so the benefit is calculated by multiplying £20,000 by 2.25%, which gives us a cash equivalent of £450. Additionally, the employer would also have to pay 15% on this cash equivalent of the benefit, so this would be £450 times 15% to get £68. Finally, we come to employer-provided accommodation. A taxable benefit arises where the employer provides accommodation that is not job-related. The cash equivalent is calculated in two steps. The first is the basic charge, which is the hire of the property's annual value or the rent paid by the employer. The second is the additional charge, which only applies if the property costs more than £75,000. This is calculated as the cost of the property minus £75,000 multiplied by HMRC's official rate of interest. In our example, the property costs £200,000, the annual value is £5,000, and it is owned outright by the employer and there have been no improvements. So here, the basic charge is £5,000. The additional charge is calculated as £200,000 minus £75,000 multiplied by 2.25%, which equals £2,813. Therefore, the total cash equivalent of the accommodation benefit here is £5,000 plus £2,813, giving us a total of £7,813. The employer's Class 1A national insurance due on this accommodation benefit would be £7,813 times 15%, which gives us £1,172. So in summary, some benefits are valued at the actual cost to the employer, while some follow specific HMRC rules. It's important to understand which method applies to ensure accurate reporting and compliance. So we've just outlined two methods of how we value a benefit, either using cost to the employer or some of our special rules. However, I didn't mention that there is another way that we value a benefit in particular circumstances. There's a ruling that the taxable value of an in-house benefit is based on the marginal cost or additional cost to the employer, not the cost to the employer or using the special rule. So, what are in-house benefits? These are goods or services provided by an employer from within their own business. For example, discounted rail travel for railway staff or school fee deductions for teachers. This means that the taxable value is only the extra cost to the employer. It does not apply to benefits which use a special rule to calculate the cash equivalent, so not our company cars, loans or accommodation. There are some instances where the marginal cost is nil. For example, empty train seats used by staff. The train will be running even if the staff didn't get on it. Or legal advice from in-house lawyers, or maybe even a restaurant which allows kitchen staff to take leftover meals at the end of their shift. Where marginal cost is nil, there will be no taxable benefit on the employee and no Class 1A national insurance to pay by the employer. An example of where we might have a taxable amount for the marginal cost is if we have a scenario in a clothing store where an employee was given clothes for free. The marginal cost here, and therefore the cash equivalent, would be the additional cost to the employer to buy those items of clothing. By using the marginal cost instead of the cost to the employer or special rules, we can help establish a fair taxable value for employees. So now that we have discussed the ways that we value a benefit, let's break it down how employers can report these benefits. The first way to report a benefit is via a P11D form or via payroll. Employers can choose to report certain benefits through payroll rather than submitting a P11D form for an employee. Through payroll, the cash equivalent is split between the pay periods and added to an employee's taxable income. This is currently on a voluntary basis with the mandatory implementation dated for April 2027. Today, however, we will only be exploring how benefits are reported via a P11D form. The P11D form is used by employers to report the value of benefits in kind provided to employees. This includes things like company cars, health insurance, interest-free loans, and any other non-cash benefits. Employers must complete a P11D form for each employee who has received taxable benefits, and it must be submitted to HMRC by the 6th of July after the end of the tax year. The form details the value of each benefit and that amount is added to the employee's notice of coding. This has the impact of reducing their personal allowance. Employees should also receive a copy of their P11D, which is important for them to check accuracy when completing their tax returns. As we've just discussed, P11D forms are used to report individual employees' taxable benefits. But alongside that, employers also have a liability. They need to pay Class 1A national insurance on the total value of those benefits. That's where the P11D-B comes in. This is the form used to summarise the total Class 1A national insurance due on all the benefits reported across every P11D submitted by the employer. It's important to note that even if an employer stops providing benefits and doesn't need to submit individual P11Ds in a future year, they still need to file a nil P11DB if they submitted one the year before. HMRC will expect a return unless told otherwise. The deadline to submit the P11DB is 6th of July following the end of the tax year. This is the same deadline as individual P11D forms, and don't forget the payment of Class 1A national insurance is due by the 19th of July if paying by post, or 22nd of July if paying electronically. Missing these deadlines can lead to penalties and interest charges, so it's important to get this right. Now that we have discussed both P11D and P11DB forms, let's use a couple of our examples we've used previously in the session to help understand the forms and how the change in notice of coding works. Let's say we have two employees who both work for the same employer. One of the employees is a basic rate taxpayer and receives private medical insurance where the cash equivalent is £100. This would be input in a P11D form on Section I, which is for private medical treatment or insurance. Now, how would this be taxed? Let's assume that this employee has a standard personal allowance of £12,570 for 25-26 tax year. This is the amount of income that is tax-free during the tax year and is reflected in their tax code 1257L. HMRC will see the P11D submitted by the employer and adjust this individual's tax code by reducing their personal allowance by £100. This will make their tax code 1247L, and therefore they are being taxed an additional £100 of their income, and this will be at their marginal rate of tax of 20%, so they will pay tax of £20 on this benefit. Moving on to the other employee, who is a higher rate taxpayer, and they received the same private medical insurance and also a company car. The cash equivalent of these benefits is £100 and £2,400 as we worked out earlier in the session. The private medical insurance would be input in Section I on the P11D, and the company car would be input into Section F. Following the submission of these forms, since the total cash equivalent of these benefits is £2,500, the employee's tax code will change from the standard 1257L to 1007L. Therefore, they will be taxed on additional £2,500 of income at their marginal rate of tax. In this example, they are a higher rate taxpayer, so they will pay tax of 40% of £2,500, this being £1,000. So now we've had a look at the P11D forms for the employees, let's move on to the P11DB, which must be submitted by the employer as they are providing employees with benefits. On the P11DB form, the employer will have to enter the total benefits liable for Class 1A national insurance. For this example, the total value of the benefits provided is £2,600. This is for 2 medical insurance and 1 company car benefit. Therefore, the total Class 1A will be 15% of this value, so £2,600 at 15%, which will be £390 using the 2025-26 rates. Moving on from P11Ds, we also have an alternate way of reporting via a pay-as-you-earn settlement agreement. This is the net that catches everything else not captured by P11Ds. A PSA allows employers to pay tax and Class 1B national insurance contributions on behalf of their employees for certain types of benefits, like low-value benefits or benefits that are difficult to value or one-off irregular items. The deadline for the application for a PSA is the 6th of July after the end of the tax year. The payments are due by the 19th of October or 22nd of October if paying electronically. Instead of the employee being responsible for reporting these benefits, the employer assumes the tax liability and reports benefits through the PSA, which simplifies the process for employees. It's important to note that the PSA is optional and typically used for minor benefits or where reporting burden is too high for individual P11Ds. Let's move on to an example of how a PSA, or pay-as-you-earn settlement agreement, works in practice. Suppose an employer gives a £100 voucher to a basic rate taxpayer. Under a PSA, the employer agrees to cover both tax and national insurance due on that benefit, so the employee doesn't bear any of this cost. Because the employer is paying the employee's tax rate, pays tax, that payment is itself considered a benefit. This means that we need to gross up the value of the voucher using the employee's marginal rate of tax. First, let's calculate the tax. Since the employee is a basic rate taxpayer, the gross up factor is 100 over 80. That gives us £100 multiplied by 100 over 80, which is £125. So the tax the employer is covering is 125 minus 100, which is £25. Next, we calculate the Class 1B national insurance. For 2025-26, the employer's rate is 15%. We apply that to the grossed up amount, so 125 times 15% gives us £19. Now let's bring that all together. The tax is £25, the national insurance is £19, and so the total cost to the employer for giving a £100 voucher under a PSA is £44. This amount must be paid to HMRC by the 19th of October following the end of the tax year, or the 22nd of October if paying electronically. A key point to make about PSAs, while they offer convenience, especially for irregular or minor items, they can be expensive. Employers need to consider whether the administrative ease outweighs the financial impact, particularly when dealing with larger or more frequent benefits. Let's now take a look at the key differences between P11Ds and PSAs. These are often confused, so it's important to understand how they apply differently. First, with a P11D, the employee is responsible for the tax on the benefit, while the employer pays Class 1A national insurance. With a PSA, it's the employer who takes on the full liability, and they pay both the tax and the Class 1B national insurance on the employee's behalf. Second, P11Ds are filed annually for each individual employee, with the benefit assessed separately for everyone receiving it. On the other hand, a PSA is a single annual return that covers all employees impacted by the agreed terms. It doesn't require individual assessments. Third, P11Ds are used to report ongoing or regular benefits such as company cars or interest-free loans. A PSA, by contrast, is used for irregular, minor, or low-value items, so for example, staff entertaining or small gifts that don't justify individual reporting. And finally, if a P11D is filed late or payments are delayed, there can be penalties and interest on Class 1A national insurance due. Whereas with a PSA, there are no late filing penalties, but interest may still apply on late payment of tax and Class 1B national insurance. This table gives us a clear view of when each approach is used and the different compliance obligations that they carry. Let's take a look at how a benefit with a cash equivalent of £1,000 would be treated differently under a P11D versus a PSA. If the employer reports the benefit through a P11D, the employee is responsible for paying the tax. That £1,000 will be added to their income and taxed via a tax code adjustment. The employer will still pay Class 1A national insurance at 15%, which comes to £150. So in this case, the employee feels the tax impact directly. Now let's compare that with a PSA. If the employer agrees to settle the tax and national insurance on the employee's behalf, they must gross up the £1,000 using the employee's marginal rate of tax. For a basic rate taxpayer, that means multiplying by 100 over 80, giving a grossed up amount of £1,250. The liability is then 20% of £1,250, so £250. And Class 1B national insurance at 15% is applied to the £1,250, which gives us £188. That brings the total cost to the employer under a PSA to £438. So the key takeaway is that a PSA shifts the full cost to the employer, including both tax and national insurance, while a P11D places the tax responsibility on the employee and only the national insurance on the employer. To close, let's recap the most important points from today's session. Employment income goes beyond just wages. It includes a wide range of benefits that can be taxable. The way these benefits are valued and reported matters significantly, not just for compliance, but also for managing tax risk and cost. We explored how income is taxed on a receipts basis, how benefits are valued using either cost to the employer, special rules, or marginal cost, and the importance of understanding which method applies in each cases. You also saw the two main ways to report benefits, through P11D forms, where the employee pays the tax, and through pay-as-you-earn settlement agreements, where the employer pays tax and national insurance on the employee's behalf. Each method has implications for tax liability, timing, and administration, so it's vital to get it right. As we move on to future sessions, we'll build on these foundations with more specific examples and technical guidance. But for now, understanding these core principles is the key to getting started with employment taxes the right way. So that concludes our very first session of Employment Taxes on Demand. If you have any questions, please feel free to contact us via email at employmenttaxesteam@unw.co.uk. Thank you so much for your attention.